Alright, so last week we talked about the demand for money, specifically the different motives why people hold money. So if you can remember, the transaction motive, precautionary motive or for contingency purposes, and then we also have the speculative or asset motive. And then I also discussed the relationship between the interest rate and the money demand through the money demand curve. Okay, now today I'll talk about money supply, which at the end of this session you guys will be able to discuss the concept of money supply and the money multiplier and evaluate how banks create money and contribute to the economy's money supply. Alright, so what is money? Money supply. What is money? What is money supply? Now when we say money supply, it can have different definitions according to what we consider to be used for transactions. Now money supply or money stock is defined as the quantity of the money available in the economy over a period of time. Now what are the assets included or counted in the money supply? So we have two, the currency and the deposit. So when we say currency, it's the paper bills and the coins in the hands of the public. Kaning Philippine peso, kaning 100, 200, kaning bills, coins, mga peso coins, it's included on the currency. And then we also have the deposit. These are the balances in the bank accounts that a depositor can access. And also kaning credit card and debit cards, they are included under deposits, since this type of cards can allow the depositors to use their money through their deposit in doing transaction. So that is on top of the currency. Now with that, we can say that our money supply is equals to currency plus deposits. Okay, so that is money supply. Now in measuring the supply of money or the money supply, it varies from country to country and from its purpose. Now different countries follow different practices, but in the Philippines, according to the Bangko Sentral ng Pilipinas, these are the indicators or the measurements of our money supply. So we have M1, M2, M3, and M4. Now for M1, it's also called narrow money, comprised of currency in circulation and demand deposit. So these are transferable deposits, kaning demand deposit here. Kaning mga cash that you have on hand, it's under currency. Kaning managers, mga cashiers check. So included na siya sa demand deposits. Then M2, composed of M1 plus savings and time deposit. So when we say near money or quasi money, it consists of highly liquid assets. So highly liquid, but they are not cash. However, you can convert this asset into cash. So mo ni siya kaning mga savings and deposits. So that's near or quasi money, M2. We also have our M3 or the domestic liquidity. So comprised of M2 plus the deposit substitute. Okay, so included here are the securities, like all types of money market borrowings, kaning mga promissory notes from the bank, certificates, mga commercial papers are included sa atuang M3. And then finally, we have our M4 or the expanded liquidity money, comprised of M3 plus the foreign currency deposits. So foreign currency deposits, that is of the residents of the economy. So that's M1, M2, M3, and M4. Okay, now what you see here is the actual amount of money supply based on the four indicators. You have M1, M2, M3, M4 from the Bangko Sentral ng Pilipinas report on economic and financial developments for 2020, quarter 1, quarter 2, quarter 3, and quarter 4. Now for M1, these are the narrow money. So for fourth quarter of 2020, it's 5.4 trillion pesos. M2, composed of 4, which is M1 plus 5, and other deposits included in broad money, savings, and time deposits. It's at 13.5 trillion. You have M3, the broad money, composed of, no, this is the domestic liquidity, 3 plus 6, so M2 plus securities other than shares included in the broad money. So that's 14.2 trillion, and then M4, 2 plus 7, getting M3 plus the transferable and other deposits in foreign currency of the residents. That is 16.2 trillion. Okay, so these are the monetary indicators gathered by the Bangko Sentral ng Pilipinas. Alright, so aside from printing money, the supply of money in our economy depends on two things. First is the central bank, and then second is from the commercial banks in our country. So we already know that central banks in the Philippines, or the Bangko Sentral ng Pilipinas, well, not only in the Philippines but all over the world, they are empowered to issue currency. So therefore, we can say that the central bank is the primary source of the money supply. Okay, so the role of the central bank is that they oversee the banking system and regulates the money supply. Now, to do that, the Bangko Sentral ng Pilipinas, especially in the Philippines, they uses different monetary policy tools. So if you look back to our discussion about monetary policy, we have different tools that the Bangko Sentral ng Pilipinas uses to control and balances our money supply. So these are the open market operations. We have the reserve requirements, so katong OMO, or open market operations, where government can sell or buy bonds. Then reserve requirements, that is imposed or regulated by the Bangko Sentral. And then we have the discount rate. Okay, those are the monetary policy tools that the government uses to control and balance the supply of money in our economy. So for more information about that, review na lang mo sa monetary policy na atong discussion. Oh, by the way, the currency that is being issued by the central bank, we call it the fiat money. So that's the Philippine peso that we have right now, the bills and the coins. So our currency is backed by a reserve. Okay, and then the value of our currency is only guaranteed by our government. So we can say that the currency that you have right now on your hand, okay, that is a liability of central bank and our Philippine government. Alright, so no other sources ana siya ang value ana. So it's a trust na lang yun between our government. Now another major source of our money supply is through the banking system of our country. Now commercial banks specifically, they create money or contribute in the money supply through borrowing and lending transactions with the public. So that is in the form of loans, like kaning mga salary loan, housing loan, car loan, computer loan, any types of loans that the commercial banks offer. It helps in creating our money supply. So how does it work? So as we know, in the bank, most money is held in the form of deposits, right? So the Bangko Sentral ng Pilipinas, they established a reserve requirements, which is a regulations on the minimum amount that the bank can keep for reserve or as reserves against its total deposits. But actually, banks may hold more money, okay, beyond the minimum requirements from the Bangko Sentral ng Pilipinas. Now that process of keeping a reserve against the total deposit, we call it the fractional reserve banking system. So in a fractional reserve banking system, banks keep a fraction of the deposit as a reserve and use the rest of the money to make loans for the public. Now we call that the required reserve ratio, or the fraction of the deposit that banks hold as reserve, or the total reserve as a percentage of the total deposit. So for our discussion today, our required reserve ratio is represented by capital R. Okay. Now to determine better the impact of commercial banks in the money supply, we will look into these scenarios. Now let's say that there's only 1,000 peso currency in the circulation. Okay, no other money. It's only 1,000 pesos. First, let's assume that there's no banking system. Second, 100% reserve banking system, or the banks hold 100% of deposits as reserves, meaning no loans. And then third is the fractional banking system. Alright, so let's say there's no banking system in the economy and there's only 1,000 peso currency in the circulation. So what will happen? So the depositor will hold the 1,000 peso currency. So therefore, the effect on our money supply is the same. So our money supply will still be 1,000 pesos. So in an economy with no banking system, it doesn't affect our money supply. Okay? Now let's say we have a 100% reserve banking system, meaning banks will hold 100% of the deposit as reserve. So let's say the depositor will deposit the 1,000 pesos at Bank X. So in a 100% reserve banking system, Bank X will hold the entire 1,000 peso as the deposit. So therefore, the money supply will still be 1,000 pesos, but now it will be in the form of deposit. So same thing with no banking system, it will not affect our money supply. But in case, or in a scenario where we have a fractional banking system, so remember, in a fractional banking system, part of the total deposit will be kept as reserve. So that depends on the Bangko Sentral ng Pilipinas required reserve ratio. Now let's say if our required reserve ratio, or big R, is at 10%. So the depositor, let's say depositor A, deposit the entire 1,000 peso at Bank X. So given the R equals to 10, or the reserve at 10%, so 10% of 1,000 is 100. So 100 peso will be kept by Bank X as its reserve, and then the rest of the money, which is 900 peso, so Bank X can loan it to borrower B in currency. So again, if A deposits 1,000 in cash at Bank X, so this serves as the Bank X total cash deposit, getting 1,000 here. So if the required reserve ratio is at 10%, then the bank will keep the 100 peso as reserve, and then the 900 peso, the bank will lend it to borrower B. Now by lending 900 peso to borrower B, the bank creates a deposit for 900 that borrower B can use. So kani 900 peso, the borrower B can use it like anything she wants. Okay, so therefore what will happen now, so remember our formula for money supply, which is C plus D, or currency plus deposit. Our money supply will increase from 1,000 to 1,900. Okay, so here borrower or depositor A will continue to have claim against the 1,000 pesos. Can you see, yeah? And then borrower B will also have a claim against this 900 peso. Okay, iha maning giborrow or giloan from Bank X. And then si Bank X has a 1,000 claim against this 1,900. Why? Because Bank X created this 900 pesos out of thin air. Since this amount here, kaning 900 peso, are not supported by any genuine money. Alright, so at any time in the fractional banking system, so banks have more cash liability compared to the cash they have on their vault. So that's how bank creates money. Right, so again from 1,000, bank create money and make it 1,900 through borrowing and lending money to the public. Okay. Alright, let's continue. Let's say borrower B, so remember borrower B got 900 peso from Bank X through a loan. So suppose borrower B deposit the 900 peso at Bank Y. So Bank Y will have now its initial deposit of 900 peso from borrower B. So following the BSP's reserve requirement ratio of 10%, then Bank Y will keep 10% of the 900, which is 90, and then the rest of the amount, 810, Bank Y can lend it to borrower C. Okay, and then let's say si borrower C will deposit the 810 peso that he loaned from borrower Y at Bank Z. Now for doing that, Bank C now has an initial deposit of 810, and then following again the required reserve ratio of the Bangko Sentral of 10%, then Bank Z will keep the 10% of 810, which is 81, and then the rest of the amount, which is 729, Bank C can lend it to borrower D. Now if we continue the process and money is created with each new loan where the required reserve ratio is at 10%, so remember the original deposit, which is only 1,000 pesos, and then Bank X lend 900 to borrower B, and then Bank Y lend 810 to borrower C, and then Bank Z lend 729 to borrower D. Now the sequence here keeps on continuing until the initial deposit amount of 1,000 pesos grows exactly by the multiple of required reserve. Now this summation would end up an amount which is equivalent to 1 over 10% of 1,000, which is 10,000 pesos. So the initial deposit is capable of multiplying itself 10 times. So 1,000 times 10, which is 10,000. Now the process here, this entire process, we call it the money multiplier effect. Okay, so turning the original deposit 10 times depending on the reserve required ratio. Okay, so the multiplier, it calculates the outcome of a change in the bank's reserve requirement to the overall supply of money in an economy. So it's the amount of money that the banking system generates with each amount of reserves. Now to get your money multiplier, it is just the reciprocal of the required reserve ratio. So our money multiplier, represented by small m, is 1 over required reserve ratio, or equals to 1 over r. So let's say if our r is 10%, so it's just 1 over 0.10, so that equals to 10. So our small m is 10. So our money multiplier here reflects the bank's ability to increase our money supply. Okay, to understand it better, another example. Now let's say while fixing your bed, you find a 500 peso bill. So you deposit that bill in your checking account, and then the bank's reserve requirement is at 20% of deposit. Now the questions are, what is the maximum amount that the money supply could increase, and what is the minimum amount that the money supply could increase? So maximum and the minimum. Okay, so let's say again that you found 500 peso and then deposited it in your checking account. Now here our assumption is that there's no other money in the circulation, it's just the 500 pesos. And also the bank has no excess reserve, meaning no other deposits aside from your 500. So our money multiplier, which is 1 over R, so 20%, so that's 1 over 0.2 or 5. Now the maximum possible increase in the deposit is just the product of multiplier times the initial deposit. So 5 times 500 is equals to 2,500. So this is the maximum possible increase in the deposit. However, remember that your 500 peso is part of the currency in circulation. So our money supply formula is currency plus deposit, right? So if we take out 500 from the currency and then we will put it in the deposit, so our money supply will fall by 500 sa currency, but it will be added on the deposit. So ito rin siyang i-minus ang 500 sa 2,500. So we can get the exact increase in money supply. So from 2,500 to 2,000. Okay, so going back to our question earlier, what's the maximum amount that the money supply could increase? So the answer is 2,000 pesos. And what is the minimum amount that the money supply could increase? The answer is 0. Why 0? Because if your bank makes no loans from your deposit, so currency will fall by 500, since again the 500 you found is included on the circulation, and then you just transferred it to deposit. So currency will fall but deposit will increase by 500. So meaning that your money supply will not change. Okay, so that's how our money multiplier works or affect our money supply.